Welcome to GRE. I'm your host, Keith Weinhold. Is the future direction of the housing market trending up or trending down? Which states have seen the most population growth? Then powerful wealth mindset tactics with a financial comedian today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
The same place where I get my own mortgage loans is where you can get yours. Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Mount Rainier to Mount Rushmore and across 188 nations worldwide, I'm Keith Weinhold, and this is Get Rich Education. I am not a Lambo driving influencer that will take any brand deal just to shill a gambling platform. Instead, our core strategy at GRE is aging well. I've spoken with a lot of LP investors with capital calls and deals that lost all their money. Well, we approach wealth building with discipline and consistency. It doesn't sound dazzling, but it really shines when things go wrong elsewhere, because at least for the core of our portfolios, we get long-term fixed-rate debt for income property, get paid 5 ways, and win the inflation triple crown. And we do it all with a high degree of passivity. Right before I took the mic today, I got a 2-sentence email from a property manager that said an air conditioning unit's air handler board had to be replaced for $420. I don't even know what an air handler board really is. Now, the manager sent some photos and a written estimate. I quickly checked ChatGPT and I saw that the price was about right and replied to my manager to go ahead and have that done. That's it. An example of relative passivity. U.S. residential real estate has nominally appreciated over every single 10-year period in modern history, despite some occasional short-term downturns. Even those are not common. Well, we recently had a guest mention that it's 20 years at the longest, like 20 years or less is the period of time between which real estate never goes down. He was right, but you actually can't find any 10-year period where home values fell. Now, what about the 2008 global financial crisis? I think that's the first place that the mind goes. Well, back then, home values bottomed out at $208K in 2009 before they started growing again. And 10 years before that, the median price it was $157K in 1999. So even when home values hit their GFC low, at that point, they were still up 32% from the previous 10 years. So you can confidently say then that over any 10-year period, home prices are up nationally. Now, how about the future? Well, for the future, there is more evidence of rising home prices. Building permits for new homes have fallen to their lowest level since 2019. That's according to the Census Bureau, so fewer single-family homes are being built. Now, we plan to discuss that more on next week's show when we dive deep on, does America really have a housing shortage? But this week, more reasons for future home price bullishness is that the labor market, now it's not doing that great. It sure isn't white hot, but unemployment, which was already low, that recently dropped a touch lower to just 4.3%. Inflation's fallen to 2.4%, and wages are rising faster than that. In fact, our own Fed chair recently remarked at how he's surprised at the strength of the economy. The property market analytics firm Cotality, they now expect home prices to appreciate another 4.5% this year. They and other firms continue to believe that the Midwest will be the hottest area of home price growth, even more than that 4.5% in that region. That is because not only is the Midwest underbuilt, it's that the prices are so affordable that it's attracting young people. The other factor is that mortgage rates recently dipped just below 6 into the high 5s again, and that can release this pent-up housing demand. And think about where we've come from. In late 2023, mortgage rates were about 8%, and now lower mortgage rates also reduce the lock-in effect, so it can create both more sellers and more buyers. The thing to remember is that 70% to 80% of home sellers are also home buyers because they've got to live somewhere. And first-time home buyers, of course, they buy only. They don't sell anything. In fact, former GRE guest and Housing Wire lead analyst Logan Mohtashami and Barry Habib were just positing on this at Housing Wire's latest summit on how the volume of home sales has been depressed for so long that lower rates could very well trigger a rush of buyers, these kind of people that have been delaying purchasing for years, this pent-up housing demand being released. If indeed rates go lower, people think they know the future, but we don't really know that that's going to happen for sure. But a lot of optimism about this phase of the housing market, supported by not great, but decent economic conditions. Of course, that new housing demand is going to manifest unevenly across the nation. So let's talk about the places that have seen the most population growth from 2020 to today. Basically, these states that support that housing demand. Well, between 2020 and today, the U.S. has grown by about 10 million people. That's over 3%. Nearly every state grew. But the bigger story is where that growth is happening. And really, here's the jaw dropper. As a region, the South gained more people than all of the other regions combined, about 7.6 million new residents in the South. Since 2020, the South's population is up 6%, the West's almost 2%, the Midwest population is up more than 1%, and the Northeast up 0.7%. Again, this is not per year. This is total population growth from 2020 to today. Florida and Texas, they led the nation among the big states, both up almost 9%, sprinting like they just found out that income tax is optional. The Carolinas and Tennessee are big southern growers too. People clearly keep moving toward warmer weather, a lower cost of living, lower taxes, and job markets. Nothing new there. California and New York are the biggest losers in absolute numbers. California losing 0.5% of population, and New York a full 1%. People keep moving away from these traditionally expensive, high-tax coastal states like a buffet when the crab legs run out. People just getting up and leaving. That's not any sort of news story there either. These trends help cash flow residential real estate investors like us because the South aligns with that favorable landlord-tenant law and those high ratios of rent income to purchase price. Luckily for us, that's where people are moving to. The Midwest has those phenomena as well, although their growth has been slower. Now, a few Midwest highlights for you. Since 2020, the population of Indiana is up 2.8%, quietly benefiting from Illinois escape velocity. Missouri up almost 2%, and that's growing mostly in Kansas City and St. Louis suburbs. Ohio at almost 1%, that's pretty modest growth overall, but Columbus up 5%, that is flexing like it just landed a semiconductor plant there in Columbus. The Intermountain West has bicep bulging growth, but it rarely works for us because rents are only a little higher, but property prices are way higher. Yes, those pretty rocky mountain states, great Instagram, tough cash flow. Now, Louisiana, it is a state that confounds people. It's a warm place and it has a low cost of living. You would think Louisiana would be attracting people in droves for those reasons. Well, then, why is its population falling? Louisiana down 0.9% since 2020. Well, you've got bleak job prospects that make Louisianans leave. Its tax competitiveness ranks 31st. Property insurance costs are high thanks to environmental risk. Louisiana has more swamps than beaches. Even the NFL Saints were 6-11. And if they had made the playoffs, that wouldn't have made people move back. And hey, no personal shade here. I enjoy going to the New Orleans Investment Conference and Cajun culture and airboat tours through the alligator-filled bayou. Fun stuff. But for income-producing property, you've got to seek out different characteristics than just vacation glee or how good the gumbo tastes. Keep emotion separate from investing. Hawaii is America's biggest percentage loser. Its population is down 1.5% since 2020. Its cost of living is stratospherically high with a median home value of just a little over $1 million. That results in net out-migration to the mainland. Parts of the Aloha State now experience natural decrease. That means that deaths exceed births. Natural decrease, that's mostly a phenomenon on the Big Island. That's not where Honolulu is. That's where you have Kona and Hilo. When young people can't afford to stay, demographic gravity kicks in. Population loss. Hawaii is also highly dependent on tourism, meaning more volatility in recessions. It has contractor availability issues and higher repair costs, partly due to shipping materials to the remote islands. What about the upsides of Hawaiian real estate? Well, you're just going to have this inherent strong long-term land scarcity and lifestyle desirability. Overall, Hawaii isn't bad, it's just hard. And I like Hawaii as a place to vacation. Some of the best times in my life were in Hawaii. Now, with all this said, these are broad generalities about states which are big places themselves. Right now, there are certainly Missouri real estate investors listening to me that are actually losing, and Hawaii real estate investors that are winning and even cash flow positive. I'm talking general trends here, and this is with respect to long-term rentals, not short-term rentals. If your rent-to-price ratio is as low as 0.3 or 0.4, like it often is near the coasts, well, then you are speculating on appreciation. That's what that means. All 50 states have opportunity. All 50 states have no-go zones. People keep moving south. That's a trend that the pandemic accelerated 6 years ago. More opportunity is concentrated there. That's got nothing to do with vacation excitement. That is population math. And I'm talking about swimming with the tide here. In our Don't Quit Your Daydream newsletter, I recently sent you that colorful population change map that I was describing some of there. More recently, I also emailed you that great and rare map of landlord-friendly versus tenant-friendly states mapped out, and a lot of other great stuff. Before we bring in our firebrand guest, Garrett Gunderson, I just learned about a really strong opportunity for a provider of single-family rentals and duplexes in Memphis and Little Rock. They're providing a locked-in 5% interest rate and 5% property management for 5 years. Yeah, that's not a throwback to 2020. It's what Mid-South Homebuyers calls their Triple 5 program. They are the oldest and most trusted, maybe, turnkey investment provider in the country, operating since 2002. And what they do is they offer these fully renovated, occupied rental properties in Memphis and Little Rock, two of the strongest cash flow markets in the South, with financing and management and rates that make the math work like it hasn't in years. So again, 5% interest, 5% property management fees for a full 5 years. You know those markets, they already have these investor advantage numbers with rent-to-price ratios near 0.8 in Memphis and Little Rock. But yeah, that low 5% mortgage rate, even for renovated properties, not just new build, that's the kind of spread that turns a good deal into a great one. So to give you an idea, if you get a 30-year fixed-rate mortgage loan amount of $125K with a 7% mortgage rate, your principal and interest payment is $832. At a 5% rate, it's just $671. So that's $160 more cash flow right there, and it's made a tad sweetener than that with just a 5% property management rate, and I don't know how long that offer is going to last, but it is available now and for the next little while. You can ask about it when you visit midsouthhomebuyers.com. That's midsouthhomebuyers.com, and you can ask them about their 555 program. More next. I'm Keith Weinhold. You're listening to episode 595 of Get Rich Education. Flock Homes helps you retire from real estate and landlording, whether it's one problem property or your whole portfolio, through a 721 exchange, deferring your capital gains tax and depreciation recapture. It's a strategy long used by the ultra-wealthy. Now, mom and pop landlords can 721 their residential real estate. Request your initial valuation. See if your properties qualify at flockhomes.com/GRE. That's FLOCKhomes.com/GRE. You know, most people think they're playing it safe with their liquid money, but they're actually losing. Savings accounts and bonds don't keep up when true inflation eats 6 or 7% of your wealth every single year. I invest my liquidity with FFI, Freedom Family Investments, in their flagship program. Why? Fixed 10 to 12% returns have been predictable and paid quarterly. There's real-world security backed by needs-based real estate like affordable housing, senior living, and healthcare. Ask about the Freedom Flagship program when you speak to a Freedom coach there. And that's just one part of their family of products. They've got workshops, webinars, and seminars designed to educate you before you invest. Start with as little as $25K and finally get your money working as hard as you do. Get started at freedomfamilyinvestments.com/GRE or send a text now. It's 1-937-795-8989. Yep, text their Freedom Coach directly. Again, 1-937-795-8989.
This is Freedom Family Investments co-founder Danny Lynn Robinson. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Today's guest is someone that America knows as the long-haired, bearded money guy. In the past, he's drawn physical appearance comparisons to Jesus Christ. He's a prominent financial strategist, founded an 8-figure company, hit the Inc. 500. He's both a New York Times and Wall Street Journal best-selling author. He is just an electric speaker, including appearances in front of dozens of billionaires. And he's just got this great way of speaking to financial freedom that hits you differently. He even has a comedy special. It's great to welcome back to the show, Garrett Gunderson.
That's good to be back, man. It's really good. Love your energy. That's a nice intro.
Well, you give a lot of nice guidance to people that's somewhat different than they're used to hearing. You know, Garrett, I think a lot of the conventional guidance is, it's not very far above elementary school advice, like put your credit card in the freezer so you don't use it too often. But a lot of times you speak to either business owners or people that have already had some success. And I think a lot of your underlying mantra is, hey, you better live your best life now.
I kind of feel like you are your greatest asset. And if you starve out that asset because you don't feed it with knowledge or you don't invest in yourself or you don't gain the skills that really matter because you're so addicted to scrimping and sacrificing and building your balance sheet, right? Trying to build savings accounts and retirement plans and doing all you can to pay off that mortgage. Yeah, you could become a millionaire on paper, but will you live like one? Will you enjoy your life? What about all the memories that you miss along the way? What about having quality of life today and creating a life you don't want to retire from? The wealthy people, they didn't get that way because they shrunk their way there. They didn't get that way because they were amazing budgeters. They built businesses. They created value. They learned how to, sell or speak or market or have business acumen to grow a business or to hire people, and having those systems that actually impact more people or more deeply impact the people that they serve, because it's about value creation and they're value creators. And I think this notion of just thinking, I could just trade time for money and set money aside, man, that's a really painful way to get to $1 million. But Northwestern Mutual, they just put out an article that said 32 or 34% of millionaires don't feel wealthy. Because if you have money tied up in an account that isn't kicking off cash flow, it doesn't feel like wealth. You can't spend that net worth. It's just a statement. If you don't learn how to create cash flow, and I love financial independence where people have cash flow from assets to cover their expenses. Now their lifestyle is covered from that cash flow. Now they can reinvest every active dollar into themselves and their quality of life, into more cash flowing assets, into taking trips along the way, not just waiting until they're too old to enjoy it.
You work with business owners all the time, and you've even worked with some ultra high net worth people that still seem to scrimp and save. Do you think, really, what is that the function of? Is it more of the wrong mindset or the wrong tactics when someone acts that way?
It's a mindset that's really kind of handed down to them.
Yeah.
Maybe from their parents or grandparents or from a different era. Like there's people that were, in the Great Depression that then tell stories to their family about how tough it was. And you never know when that money could go away, so you got to hold tight. And it's a scarcity mindset. So one of the wealthiest clients I ever had, this was a guy who, he was worth a lot of money, but you would never know it. I saw him on TV one day. I was like, dude, he needs new clothes. And we found a strategy to save him a bunch of money. He was just buying his inventory with cash. We're like, let's buy it on a Plum card and you'll get cash back. I just said, just take 10% of that cash back, which was over $100,000 a month, and spend it on yourself. He's like, well, I wouldn't know to spend it on. I'm like, well, how about some new clothes to start with? He's like, okay. And then the next month he bought a Nest system for his house. The next month he bought a sound system. Eventually he saved up enough money to buy a Tesla, which he really wanted. Like it was money that was there for him, but it changed his entire paradigm because now he had a quality of life. He was very philanthropic and donated money. He built massive businesses, but he never treated himself well. He never felt like it was okay to spend that money because of his upbringing, because of the way that his parents viewed money and the way that their parents viewed money. And it was always something that felt scarce. So it felt like, okay, will this go away? And the reality was, we just found money in your couch cushions, essentially. So why not enjoy it along the way? He eventually bought a home that he loved on the water, that he loves to garden. It was like a total transformation with that one simple thing to help him heal his relationship with money, overcome scarcity, because he was already highly productive. He just had to break free from this budgetary mindset.
That's great. It was almost like, dude, I can see it in you before we even talk. You got that coat off the rack at Burlington. I swear, you can do better than this. Come on now.
30 years ago too, It doesn't even fit anymore.
Well, I recently dedicated a complete episode, Garrett, to the way I put it is that the risk of delayed gratification is denied gratification. Now, there are some good things to be said for delayed gratification. I think especially when you're younger or you're just starting out in the working world and you're just trying to cover rent for your apartment and you don't have much else. Delaying some gratification is good. You need to form capital. You need to get liquid. I try to avoid saying stacking savings because that gets people in the mindset of becoming super savers sometimes and they miss out on returns. But what I mean about the risk of delayed gratification being denied gratification, if it's taken too great of an extent, is, I'm talking about the guy where when he was 24, he used to say, oh, I'm going to visit the Galapagos Islands someday. That's what I want to do. But you can just tell by the time you talk to the dude when he's 48, he begins to use the past tense for things he wanted to do. For example, then he might start saying, oh, well, I guess I never did visit the Galapagos Islands. You can tell with people when they use the past tense, and that's when you know that their future's not bigger than their past. And a lot of that is the reflection of their financial status.
I got married at age 23. And the first 2 years, well, it was really like the first year and a half, maybe. I was such a miser. I gave my wife a $400 a month budget for our apartment. And we found out that there's places you don't want to live in Utah. I didn't know it, but she's like, is this what you want? And I was like, this doesn't feel like a safe neighborhood. And then, I was like, all right, maybe $600. I was still kind of really scarce. And my parents were like, why don't you just live in our basement rent free? And my wife's like, sex free if you think that's where we're living. I'm not living in my parents' basement, because I just thought money was something to save. So I was saving over 50% of my income. And a lot of people are like, that's amazing. Congratulations. Great job. And so I felt really good about it. And then I realized that my business wasn't growing as fast as this other person my age. I met him at an event, and a year later, he was doing better. And I was like, dude, what's going on? I could hear it in your voice. I could hear like you're just a different person. He goes, oh, well, I'm doing two things. One, I just hired this guy, Steve D'Annunzio, and he changed my entire life. And I was like, I need to meet him. He's like, he happens to be here in Vegas. He's from Rochester. Introduced me. I hired him as my coach right away. I'm hearing all these people talk about strategic coach at the same event, and they had a booth. So I signed up for strategic coach, which meant I had to part with some of my money. I think it was $7,500. I hired Steve as a one-on-one mentor, and all of a sudden I was investing in myself.
Yeah.
And I broke free from those chains of like reduction and restriction into the game of production. And then I even had a situation where a woman called me out at the same event. This was a life-changing event where she's like, I wonder what it's like living in the financial prison you built for your wife. I was like, oh, see, that's what happened. I thought I was responsible, and building that responsibility, I was actually building walls. And when I came home for that event, my wife and I started looking for our home. Within a few months, we found one. I bought a home that was very easily within my means. I basically made as much as I paid for this house that we loved. We lived there for 9 years. We built so many memories. We had our 2 kids while we were there. I started to host study groups. And that year, I grew my income by $170,000 with the coaching of strategic coach, Steve D'Annunzio, and this woman, Nancy, calling me out. The next year, it grew by even more because the skills started to compound. I decided from that moment forward, I would spend at least $40,000 a year, which I might be out of reach for some people, but at least $40,000 a year on mentors. There's a guy named Alan. He writes my meal plans and my workouts, and I'm at 10% body fat because he knows exactly what to do. I do what he says. It was worth this $10,000 investment because now I pay attention to what I pay for. And I look at like, if I'm my greatest asset, how can I create more energy? How can I create more value? How can I feel better about myself? How can I show up the very best version of I am so I can deliver the most to the other people? And so I've always just been in amazing groups. I just got back from 2 different events in Beverly Hills around amazing people, learning incredible things that allow me to grow. I even spent a huge amount of money on a mentor last year to figure out something that I hadn't been able to figure out to this point. And it's the same thing I did to become a speaker, to become a writer, or even learn how to sell or market. You've got to invest in the skill, not just in the savings account. You grow yourself first, and then you grow your money. If you starve yourself out because you're in that miserly mindset, you're going to stunt your growth and never be fully fulfilled.
You're your own best investment. And yes, this stuff is the very definition of investing in yourself. Don't live below your means, grow your means, and all of that.
Grow your means and be more efficient within your means. I mean, the best way I know how to save is not overpay on tax, which 98% of business owners are doing that today. Don't overpay on interest because you either restructure your loans, renegotiate your interest rates, or reallocate underperforming funds to pay it off, or you remove investment drag. A lot of people have unnecessary fees and hidden commissions that drag on their investments, or just design your insurance properly so it's more efficient. Those 4 I's, IRS, interest, investments, and insurance, show you how to keep more of what you make. Take some of that money, build up your foundation so you have a peace of mind fund, so you have staying power, at least 6 months of liquidity, and then invest more into yourself or learn how to create cash flow. This is the game the wealthy play. But the poor middle class, they think it's about paying off a mortgage and funding the retirement plan. And they will argue about it until it's too late when they get there and now their home's paid off, but the property taxes are higher than their mortgage was 20 years ago, or they have home maintenance they have to take care of, or inflation has destroyed the value. Like if someone were to put away $100,000 and they wait for 30 years, if they got 10%, which the market did the last 30 years, if you reinvest dividends, they're going to have right around $1.7 million. But if they have to pay 2% in fees, fiduciary fees, 12B1 fees, which are marketing fees for the fund, expense ratio, the fees of maybe a retirement plan, and they now have 2% fees, it only goes to 1.1 million. Huge difference. And that 1.1 million, if we account for inflation, even if we said inflation was low, like 2.7% over that 30 years, well, by the time we pay for inflation and tax, guess what? The purchasing power value is like $300,000, $300,000. That's a problem. And it's because they didn't learn to create cash flow. It's because they didn't learn to invest in themselves. It's because they relied completely on a market they don't control. I'm not saying the market is completely something to avoid. I'm saying we go in sequence. How do you grow your income first? Then how do you keep more of the income you make with, financial savvy and plugging leaks? Then learn to grow your money. But maybe growing your money, for some, I like to think of like three-dimensional assets, like real estate's three-dimensional. It can grow in equity, it can create cash flow, and it has tax advantages. But my business is three-dimensional. The more my business creates cash flow without me, the more equity it has. And that business has major tax advantages. So most people are one-dimensional. Pay off a loan, put in money in a retirement account. That's the poor and middle class. Wealthy people build a system where they've got three-dimensional assets, equity, cash flow, and tax savings. And that is a complete game changer because then they can employ the buy, borrow, die strategy. If you have assets like an individual stock, or if you have assets like a piece of real estate or a business, you could borrow against it. There's no tax on that.
5 for life.
Right? You keep refinancing, or you can even do charitable trusts to avoid the taxes upon the sale of those, paying no tax when there's gains. Or you can pass it on to the next generation with a step up in basis, which means they get it at the full value and not have to pay the difference. And if you have life insurance, the life insurance will pay back the loan that tax-free as well. So buy, borrow, die. I mean, it's a completely different thought process of defer taxes. If you defer taxes, I get it. You could do a Roth IRA or Roth 401k. Sure, that'll let you put after-tax money in and grow it. But where's the cash flow? What's the underlying investment? How does it help you create financial independence? How does it help you grow your skills to become a better investor? We've been taught to be lazy. Not that people are lazy. We've just been taught to be lazy with our money. We've been fed a narrative. I don't have the time. I don't have the skill. I don't have the interest, but I want to have it. So I just hand it over. And who do we hand it over to, Keith? Wall Street. Would you trust Wall Street? Like, you flew to Frankfurt not long ago. Would you get on Wall Street Airlines where they're like, hey, sometimes our planes go up, sometimes they go down? If that would brand, you'd feel inspired, right? Would you go to Wall Street, hospital where like, hey, you lost one of your kidneys, and by lost, we stole it and resold it. Like Wall Street doesn't have a brand that's good. It's Boiler Room. It's Wolf of Wall Street. It's the movie Wall Street with Michael Douglas. Greed is good. Like, yet that's what people put their money into. And you can go to any downtown in any major city, and guess who has the biggest buildings? Insurance companies, banks, and Wall Street, investment companies. So you're taking the size of your home and shrinking it to build up their building and put money in their pocket. And their story is it's because they're Ivy League, they're smart, they try to make it complicated. But you don't have to know most of the things you think you need to know about finance. The foundational things are important. How to protect your assets, how to design insurance to transfer risk, how to have some liquidity, how to automate your savings. And then you focus, like Warren Buffett would teach. He said, you know how people would become a better investor? If they only had 20 investments they could make over their lifetime. He says, I don't diversify because I'm in the know. He's like, I'm a good businessman, therefore I'm a good investor, and I'm a good investor because I'm a good businessman. I don't separate the two. Yeah, most people think he's a stock market investor. No, he buys out the companies in the stock market. Rarely does he have minority stakes in it. He does have some of that, maybe with Coca-Cola and Apple, but he bought a lot of companies outright, whether it was Geico, whether it was See's Candies, whether it was, like, he buys these companies. He's so far outperformed the stock market by billions of dollars from an index fund. Like what he has versus someone that put the same money in an index fund, Warren has billions more from his investments than the person that put all their money in an index fund, even if it was the same amount. It's completely about strategy, not about luck.
Yeah, it's the Andrew Carnegie, put all your eggs in one basket and then
watch it like a hawk.
That basket. Yeah, 100%.
Yeah, watch that basket like a hawk. Totally.
Yeah, I mean, stocks, mutual funds, they have what I call those 5 simultaneous drags. If you think you're getting a 10% long-term return over time, subtract out inflation, emotion, taxes, fees, and volatility. What do you have left? Not much, but there's no friction there. It is just the easiest thing to do. Ever since decades ago, 401k contributions began to become automated throughout your paycheck, sometimes even automatically automated.
Without your permission, you have to opt out.
It's easy.
You have to opt out, right? It's Big Brother. You don't know what's best for you. And by the way, how crazy are 401ks? Part of the reason the market has gone up in value is because people consistently fund 401ks, whether the market's going up or down. They're told dollar cost average. So that's artificially fueling the market. When we see the numbers, there's a Buffett index, and it's like 2.9 times higher than what he's comfortable with the stock market because of how overinflated the market is, partially due to inflation, partially because people put money in. But let's remember, why did 401ks even come about? Because pensions failed. And by the way, these pensions failed, and they had world-class money managers managing these multi-billion-dollar pensions, but they didn't know about something called disinvesting or didn't know enough about it. When the market goes down and pension money is owed, they still have to pull money out of the pension to pay the employee, which disinvests, which pulls more money out of the account. So now instead of just being 10% down, they might be 17% down. And so even if the market comes back 10%, it's 10% of only 83% of the money. So not even back to square one. And if it goes down a second year in a row, they're in real trouble. It starts to chip away at the principal and they can't recover. And that happened to pensions. And they said, oh, here we can't handle these. We're going bankrupt. We're going to get rid of pensions. You take care of it. Well, guess what? Vanguard says the average balance in a 401k right now is $148,000. How's someone supposed to live on $148,000? Even if you could get 10%, that's $14,800 a year, taxable. That's not going to do it. Even if you have $1 million, where are you going to put the $1 million to get the return without risking it going down? Maybe you're going to be in treasuries at 5%. That's $50,000 taxable per year. You're a millionaire on paper, but living poorly. That's why I'm here to call these things out. I think that my book, Killing Sacred Cows, which was my original New York Times bestseller, which is probably how we met, I rewrote it. Re-released it in 2024, and I'll give people the audiobook. They just have to DM me on Instagram, Garrett B. Gunderson, and DM the word cows with Keith's name, Cows and Keith, or Keith and Cows. I'll hook you up with the book for free so you can learn about the 9 financial myths. We're talking about some of them here, but there's also some comedy in there so they can laugh after each chapter. I threw some comedy in there, if you like my comedy. I'm not the funniest comedian. I'm just the funniest money comedian. That's the reality.
When we had the very inventor of the 401k plan, Ted Bennett, come onto the show, he revealed to us that when 401k plans rolled out, they were first called salary reduction plans. They had to scrap that name in order to foster participation, but reducing your salary is still principally what it does to you. You got to think about it that way and blow up some of these myths. But Garrett, you've already given a lot of great technical information about what someone can do, how someone can think differently. Bigger picture, as we're sort of winding down here, when I'm thinking about this whole delayed versus denied gratification thing, how do you meter it out right throughout your life? I mean, once you earmark your family legacy, how do you meter it out right so you don't have too much or too little at the end of your life?
I like to see the strategy of like what the Rockefellers do that I wrote about is, the beginning before that strategy is you pay yourself first, which has always been around. Richest Man in Babylon, tons of books talk about it. My argument is you want to pay yourself at least 15% of your personal income off the top to a separate account. Once you get 6 months in that account, now you start to invest that money, but you build your stability with that peace of mind. And we want 15% because the luxury once enjoyed becomes a necessity, so you want more money in the future, not less. Propensity to, there's also just like planned obsolescence. Things break down, you have to repair them. Technological change. We're buying new technology that doesn't even exist. I have now subscriptions to a bunch of AI things that help me out, right? But I'm spending more money. There's also taxes. Those could go up in the future. We're $38 trillion in debt as we film this, which is a crazy number. And there's also inflation. If we give 3% to each of those 5 factors, that's 15%. Now, again, use the 4 I's, IRS, interest, investments, and insurance to find that money, not just budgeting. But then here's the magic. At least 3% of your income should go to a separate account called the Living Wealthy account. That's your guilt-free spending, value-based spending account, so you enjoy some money along the way. These are the things that are the finer things in life that people might say are wasteful. There's a book called Unreasonable Hospitality that talks about this. 11 Madison Avenue was the number 1 rated restaurant in the world. And, Will, who wrote the book, talked about they had 3% of their budget to just go wild on their customers, dream-making money, right? So to create the special experience in the restaurant. And even The Bear, I think it was season 3, showed some of that process of how they do that. So I highly recommend taking a certain percentage you get to enjoy along the way. It could be higher than 3%, but start there and you're going to feel better. You're going to have different energy. You're going to show up in a different way. And then from there, I just believe in having trusts so that your money's outside of your estate and protected from financial predators. So you own nothing but control everything. And I personally use life insurance. I use just standard basically properly structured, optimally funded whole life. So that death benefit will come in after I die. It allows me to spend more of my money and then have it replenished. So I can enjoy more of my money along the way because I know that death benefit will be there for my wife or even for my family trust after I'm gone, so I don't disinherit the people that I love.
Garrett Gunderson, he can take you through these steps, which he calls financially fit to financially independent, and then finally to financially free. Tell us a little more about that, going through those steps.
So financial fitness means your financial house is in order. You've got everything handled properly. Car insurance, homeowners, liability, disability, medical, life insurance, your corporate structures as a business owner, how you pay yourself, your taxes the last 3 years and moving forward, your investments. It's like you know what it's going on. You've improved your cash flow and you're dialed in. You're as safe as you could possibly be. Then financial independence is how can we create income, especially from a business that comes in when you don't? That's people, that's processes, that's technology, so that you can be involved, but you don't have to be involved.
This is the part most people miss.
Yeah. And I think it's crazy. A lot of people have this notion they're just going to work so hard so they can sell their business one day. I'm like, what about just creating a business that you love so much you don't want to sell it? What about giving up the things that are burning you out and have the employees that can take care of that? So you do the things that you love and then just enjoy life along the way. Take some little trips, take some time off and come back in. The business grows up when you're away. They learn how to do things without you. And then you can still create value into that business. I sold the business in 2021 and really regretted it because I kind of was so removed from the business. I kind of felt like it lost its soul and I didn't feel connected to it. So this time around, I started a business in July of 2024. I'm like, I'm only going to work with the people I love, building things that I love. And I'm not going to let myself get burned out by doing too much. We're going to take 2 weeks in Hawaii coming up here in April. Just enjoy some time together as a family. We do quarterly family retreats with my wife and kids. We do traditions with my family up at my cabin. Like, I want to have this great life where it blurs the lines between work and play. I have a little quote from someone else that talks about that. Art of life is blurring the lines between work and play, but also just having complete play sometimes, that there is no work. So I come back refreshed, relaxed, rejuvenated, and ready to create. And so really that financial independence gives you permission to swing for the fences in what you do, knowing your foundation is handled. Knowing that your lifestyle is covered from assets that create cash flow gives you work optional freedom. But instead of retiring, think, what could your biggest impact be? Like, create the life you don't want to retire from. Create a vision so compelling you can dedicate your life to it and find that the win is actually in the work, not just the outcome. I think that is the elegance of we win when we play. And when we have more play in our life, we don't try to escape from something. And when you start something, you might have to do things you hate, but you can eventually delegate it. And then life becomes great. I mean, one of my early coaches, Dan Sullivan, who I mentioned, a strategic coach, he's in his 80s, still behemoth of creating value in the marketplace.
I still listen to him.
You know, he's phenomenal. He's made such a huge difference in my life. And he has no intent of retiring. He just gets smarter every year, adds more value, builds more infrastructure. And he's the one that taught me the merit of free days, just taking time off, taking time away. So yeah, that's financial independence is cash flow. And then financial freedom is a state of mind. It's when money's no longer the primary reason or excuse you would do or not do something. It's a consideration, but it's no longer the consideration. It means that you have a healthy relationship with money. Money's an asset and an ally, not an enemy. You don't come from a place of scarcity. You come from a place of abundance. You can be more present with your family and doing what you do without feeling distracted. I think wealth is our ability to be present, not necessarily how much money we have in a bank account. I think when we have a good amount of money in a bank account and we can be present, that is like true wealth.
It harkens back to the John D. Rockefeller, he who works all day has no time to make money. Rockefeller would have said you can't architect a wealth plan if your head is down on the assembly line. That means gradually move your efforts from trading your time for dollars over to owning assets that pay you to own them. Garrett's comedy special is called The American Ream. There's no D in that word, R-E-A-M. You can look that up. Garrett, it's been enlightening as always. Thanks so much for coming back onto the show.
Hey, man, good to be back.
Always a lively conversation with Garrett. Besides some great mindset perspective, he's really good at saving you tax and setting you up with asset protection. Though he's not as real estate-ish as me, he's pretty savvy. For example, he's aligned on the fact that, say you have an $80K debt. Well, it doesn't necessarily mean that it makes sense for you to pay that off. Sometimes it does. But what happens to your net worth anytime you pay off an $80K debt? Well, let's see. You've reduced your asset side by $80K, and you've reduced your debt side by $80K. So your net worth is the same. And retiring the debt means that you might have lost leverage, lost cash flow, and lost tax advantages all at the same time. On Instagram, send a DM with the 2 words Keith cows to Garrett B. Gunderson, and he'll hook you up with his book for free. Next week on the show, we go deep on Does America Really Have a Housing Shortage with an expert analyst. Until then, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.